Welcome to Unfiltered Finance. If you're tired of the financial illusions and ready for the brutal math, you are in exactly the right place. Let's dive in. In 2024, the price of gold did something that left Wall Street analysts completely stunned. It violently smashed through the $2,400 barrier. This wasn't driven by normal market mechanics. It was driven by central banks. Specifically, the People's Bank of China, or PBOC. For 17 consecutive months, the PBOC aggressively hoarded gold at a record-breaking pace, driven by escalating geopolitical tensions and economic warfare. When retail investors see central banks hoarding gold and financial news headlines screaming about all-time highs, human psychology takes over. The fear of missing out, FOMO, kicks in. Average people start dumping their savings into gold at the absolute top of the market. But as an average investor trying to build wealth, should you actually be buying gold at over $2,400? Is gold the ultimate safe haven hedge against inflation and systemic collapse? Or is it a non-productive asset trapped in a speculative bubble? Today, we are going to strip away the hype, the gold bug propaganda, and the fear. We are looking strictly at the math. We will analyze the cold, hard, 20-year historical return data, comparing physical gold directly against the S&P 500 stock index. And more importantly, we will apply Nobel Prize-winning modern portfolio theory to calculate the exact mathematical optimal percentage of gold that you should hold in your personal portfolio to hedge against inflation without sacrificing your long-term compound growth. Spoiler alert, that optimal mathematical number is not 50%. It is not 100%. And the reason why will shock you. Because if you blindly follow the panic of the retail crowd, you will trap your capital in a non-yielding asset exactly when you need your portfolio to grow the most. Welcome to the masterclass, the golden ratio. But before we calculate your optimal percentage, we first need to understand the fundamental mechanics of gold itself. Let's begin. To understand gold, you must first understand motive. Retail investors buy gold out of greed. Central banks buy it out of fear. For decades, the United States dollar has been the undisputed world reserve currency, powering global trade through the SWIFT banking system. But in 2022, following the invasion of Ukraine, the Western world did something unprecedented. They weaponized the financial system. With the stroke of a pen, roughly $300 billion of Russia's sovereign foreign exchange reserves were instantly frozen. Inaccessible. Central banks around the world, particularly in China, watched this happen and immediately realized a terrifying geopolitical truth. If your reserves are held in digital US dollars or treasury bonds, another nation can simply pull the plug on your economy. So, China began quietly executing a massive pivot. They started dumping billions of dollars in US treasury bonds from their balance sheet, and they replaced those digital IOUs with physical gold. Why? Because physical gold held in a domestic vault is non-cancelable. It cannot be frozen by an algorithm in New York. It carries absolutely zero counterparty risk. It is pure sovereign wealth. And it wasn't just China. The entire BRICS economic alliance quietly accelerated their gold purchases, forming a parallel financial architecture. This macro trend is known as De-Dollarization. It is a slow, structural shift away from US dollar reliance toward independent assets. Here is the key. The PBOC is not trading gold to make a 10% profit. They are buying geopolitical insurance. But average retail investors completely misinterpret this signal. They see the price skyrocketing and think it is a growth asset. They treat gold like a tech stock, buying at the absolute peak, hoping for a get-rich-quick explosion. This is mathematical suicide, because for a retail investor, gold functions completely differently. To prove this, we need to put gold under a financial microscope. To understand why going 100% into gold is extremely dangerous, you must first understand the fundamental definition of an investment asset. A productive asset actually creates new value. If you buy a farm, it produces wheat, corn, and cash flow every single year. If you buy a share of a tech company, it produces software, sells smartphones, and pays you quarterly dividends from its profits. If you buy an apartment building, it provides shelter for families and generates a consistent monthly rental income stream for you. Wall Street analysts call these yield-producing assets. They actively work for you, compounding your wealth by creating brand new economic value. Now let's look at a 1-ounce bar of physical gold. what does a gold bar actually produce? Absolutely nothing. You can lock it in a vault for an entire century, and it will never magically grow a new ounce of gold. It pays no interest. It pays no dividends. In Wall Street terminology, gold is structurally a non-yielding asset, a sterile rock. The legendary Oracle of Omaha, Warren Buffett, famously avoids buying gold for exactly this mathematical reason. He prefers productive businesses. As Buffett bluntly puts it, you can fondle a giant cube of gold all day, but it will just sit there and look at you. So, if gold doesn't produce yield or cash flow, how do you actually make money? The only answer is price appreciation. You are relying entirely on the greater fool theory, the hope that someone else will pay more dollars for it tomorrow. Its price is driven almost entirely by human fear, physical scarcity, and the declining purchasing power of fiat currencies. When inflation hits, a business can dynamically raise its prices and increase its profits. Gold cannot. It just reflects fear. But does this fear-driven price appreciation actually beat the productive stock market? Let's look at the brutal 20-year data. Let's run a 20-year historical simulation. The year is 2004. You have exactly $10,000 of hard-earned savings to invest. Path A. You take that $10,000 and buy physical gold. At the time, gold was trading at roughly $400 an ounce. Fast forward exactly 20 years to the $2,400 peak. Your physical gold has multiplied by 6x. You now have roughly $60,000. Sounds amazing, right? But look closer. If you bought at the 2011 peak, you suffered through the lost decade, 9 agonizing years where your capital did absolutely nothing. That is the mathematical punishment for buying into a FOMO bubble. Now, path B. You take that exact same $10,000 in 2004 and you buy a low-cost S&P 500 index fund. But here is the secret weapon. You turn on DRIP, dividend reinvestment. Every quarter, those companies pay you cash, and you use that cash to automatically buy more shares. Fast forward 20 years. Your S&P 500 total return? Roughly $67,000. So gold gave you $60K, and the S&P gave you $67K. They look mathematically close. But wait, that S&P return happened because real humans invented the iPhone, revolutionized e-commerce, and built AI. It generated real economic value. Your physical gold return? It actually cost you money to hold. You had to pay for vault storage and insurance. This highlights the single most important concept in investing: opportunity cost. The price of holding a sterile rock is missing out on owning productive assets. Warren Buffett famously said he would rather own every farm in America than own all the gold in the world. This is why a 100% gold portfolio is a mathematical dead end for growth. So, if the S&P 500 is mathematically superior, why buy gold at all? Because of the 2008 and 2022 crashes. The S&P 500 is an incredible wealth-building engine over 30 years. But in the short term, it is a violent, terrifying roller coaster. Financial gurus will tell you that gold is the perfect short-term hedge against inflation. But the data says otherwise. In 2022, U.S. inflation spiked to an aggressive 8.5%. It was an absolute crisis. So, what did gold do? It did nothing. Gold ended the year 2022 almost exactly where it started. It completely failed as an immediate hedge. Gold is incredibly slow. It does not react to monthly CPI reports. It is not a day trader's inflation tool. Instead, gold is a centuries-long preserver of purchasing power. 2,000 years ago, 1 ounce of gold bought a premium Roman toga. Today, that exact same 1 ounce of gold buys a premium, bespoke tailored suit in New York. The purchasing power remained identical. Meanwhile, the fiat currency sitting under your mattress has lost 98% of its purchasing power over the last 100 years. This brings us to the true purpose of gold in a modern portfolio. It is tail risk insurance, not a growth asset. You hold gold to protect your portfolio against a systemic collapse. When the banks fail, the stock market crashes and fiat burns. In that extreme, rare scenario, gold acts as your golden parachute. It is the one asset that is not someone else's liability. In statistics, we call this a non-correlated asset. When the stock market goes down, gold goes up, or stays completely flat. This means the ultimate portfolio needs both. You need the aggressive S&P 500 for wealth generation and gold for systemic defense. But how do you balance them without ruining your profits? You can't just guess. You need cold, calculated Wall Street mathematics. This brings us to the holy grail of financial engineering, Harry Markowitz and modern portfolio theory. In 1952, a young economist named Harry Markowitz published a mathematical paper that fundamentally changed Wall Street forever. He mathematically proved a concept that birthed a famous quote: "Diversification is the only free lunch in finance." Here is how the magic works. Imagine the S&P 500 as a highly reactive red chemical. High growth, but violently volatile. Now imagine gold as a heavy yellow chemical. It doesn't grow much, but it acts as a powerful defensive stabilizer. By combining these two non-correlated assets, you can actually reduce your total portfolio risk without heavily reducing your expected return. To find that perfect mixing ratio, we use Markowitz's masterpiece, the efficient frontier. Let's draw the graph. On the horizontal x-axis, we map risk, measured by volatility. On the vertical y-axis, we map expected return. Markowitz calculated a curved line inside this graph. This curve represents the absolute mathematical boundary of optimal investing. Anything inside the curve is suboptimal. You are taking on way too much risk for too little reward. It's an inefficient portfolio. Anything outside the curve is mathematically impossible. If someone promises you returns up here, it is a lie, a scam. Your goal is to land your portfolio exactly on the edge of the frontier line, specifically at the tangency point. This specific dot maximizes your Sharpe ratio, a critical metric that measures how much return you get per unit of risk. When you add the mathematically correct amount of gold to a 100% S&P 500 portfolio, you shift your dot up and left. Your returns stay incredibly high, but your brutal volatility drops. This smoother ride allows uninterrupted compound interest to work perfectly. So, what is the exact optimal percentage of physical gold needed to reach this holy grail of modern investing mathematics? For a long-term investor looking to maximize growth while surviving systemic shocks, the mathematically optimal allocation to gold is just 5 to 10%. Why so little? Why not 25% or 50%? Because holding too much of a non-yielding asset acts like a heavy iron anchor. Historically, the S&P 500 compounds at roughly 10% annually with dividends. Gold historically appreciates closer to 4% or 5% on average. Over a 30-year investing horizon, that 5% gap in compounding mathematically translates to hundreds of thousands of dollars in lost wealth. So, if gold drags down growth, why not hold 0% gold? Because a 100% stock portfolio is a fragile glass ship. It moves incredibly fast in calm waters, but the moment a 2008-style economic hurricane hits, the glass ship shatters completely. This exposes the brutal reality of drawdown mathematics. If a 100% stock portfolio drops by 50% during a recession, you do not need a 50% gain to recover. You mathematically need a 100% gain just to break back even. This mathematical phenomenon is known as volatility drag. Deep losses permanently cripple the compounding power of a 100% stock portfolio. This is exactly why the 5% to 10% golden ratio exists. It acts as a financial shock absorber during the crash. But a shock absorber isn't enough. The real magic happens through an institutional mechanism called rebalancing. Here is the secret move. When the market crashes, retail panics, gold spikes, you unemotionally sell a portion of your expensive gold at the absolute peak, and you immediately use that cash to buy S&P 500 shares at a massive 50% discount while there is blood in the streets. This creates the slingshot effect. When the market inevitably recovers, your portfolio rockets past the 100% stock guy. That 5% to 10% gold allocation isn't an investment to make you rich. It is dry powder. It is ammunition. So you understand the mathematics. You know you need a 5 to 10% allocation. But how do you actually execute this? Option 1 is paper gold. These are exchange-traded funds, like the GLD ticker, that track the price of gold. The primary advantage of an ETF is hyperliquidity. You can buy and sell millions of dollars instantly with zero friction. But remember the geopolitical lesson. Paper gold is not real gold. It is a digital derivative managed by Wall Street custodians. If the financial system completely collapses, your ETF broker can freeze your account. Counterparty risk destroys the ultimate insurance policy. Option 2 is physical gold. This means buying actual minted bullion coins, like the Canadian maple leaf or American eagle. This gives you true sovereignty. Locked in your own personal safe, it has zero counterparty risk. Nobody can freeze it. But physical gold is incredibly illiquid. You cannot rebalance your portfolio by pressing a button. You have to physically transport it. Worse, when you buy from a dealer, you pay a premium over spot. The dealer takes a slice of your wealth. And once you have it, you become your own security guard. You face physical theft risk, requiring expensive safes and insurance. So, what is the analyst verdict? Which weapon do you choose to build your 5 to 10% inflation hedge? If your primary fear is a total collapse of the banking system and internet grid, you must buy physical gold. But if you want to execute the Wall Street slingshot, dynamically rebalancing to buy cheap stocks during a crash, you must use an ETF. For many professionals, the ultimate play is a hybrid. Take your 10% gold allocation and split it perfectly in half. But whatever you do, remember this. You are a retail investor trying to build wealth. You are not a central bank. When a central bank like China buys gold, they buy it with fiat currency they can print endlessly. An infinite money glitch. For a sovereign nation, the opportunity cost of holding gold is zero. A country doesn't need to generate a 10% stock return, but you have finite capital. Every single dollar you trap in gold is a dollar not compounding in the global economy. Nations live for centuries. You have a rigid 30-year retirement clock. You simply cannot mathematically afford a lost decade. So when internet finance gurus tell you to copy the billionaires or copy the central banks, they are selling a dangerous illusion. You must recognize gold for what it truly is. It is a heavy, defensive shield. It is not an offensive sword. Your offensive weapon is human ingenuity. It is the compounding, yield-producing engine of the global stock market. The S&P 500. A financial warrior entering the modern economy needs both. You cannot fight the inflation war with only a shield or only a sword. That 5 to 10% gold allocation is what allows you to sleep peacefully during a 2008-level systemic banking collapse. It frees you from the emotional FOMO matrix. You no longer care if gold goes to $3,000 tomorrow. You ignore the clickbait headlines because you know your core wealth is aggressively compounding in productive tech and infrastructure. You have constructed the ultimate 90-10 split. 90% offensive growth, mathematically insured by 10% pure sovereign defense. You are no longer gambling. You are executing a calculated, institutional-grade strategy to mathematically outpace shadow inflation. This is how generational wealth is preserved and built in a world of de-dollarization and fiat currency devaluation. But there is one final critical rule you must never break when managing this golden ratio portfolio. That rule is this: never chase the rally. When gold spikes to all-time highs and everyone is panicking, you do not buy. You stick to the math. You rebalance. You let the 90% S&P engine compound, and you let the 10% gold defend. You are no longer a victim of financial news. You are the architect of a structurally sound, institutional-grade portfolio. You leave FOMO, greed, and panic to the amateurs. You make decisions based exclusively on historical data and mathematical ratios. A critical note before we end. This video is for informational and macro-educational purposes only. It is a case study. This is not personalized financial advice. All investing carries a fundamental risk of loss. Markets can and do fluctuate constantly. Always do your own extensive research, run your own mathematical models, and consult with a licensed professional before making decisions. If you want to master the mathematical mechanics of wealth building and outsmart the emotional traps of the retail crowd, then hit the subscribe button right now. Drop a like on this video, turn on the notification bell, and stay analytical. Your future wealth is defined by the math you follow, not the hype you chase. I'll see you in the next masterclass.